back to Reinventing Finance with my co-host Tom and our next guest, Nigel. Nigel, welcome aboard.
Thank you very much, Nick. I'm delighted to be here. Thank you for having me along.
Of course. Maybe for those of our audience, and I don't think it's that many, but for the odd one out who doesn't yet know you, who's not active on LinkedIn.
You're making me blush. You can't be making me blush so early on.
It's my German self. We can't help it. You know this. So why don't you tell us a little bit about yourself? Who are you? What do you do?
Yeah, so I appreciate it. So I'm Nigel Walsh. I've just joined Google Cloud to lead their insurance business in North America. Prior to that, I'm only a few weeks into it, but prior to that, I spent 5 years at Deloitte, where I led the global future of insurance, Global InsurTech with a colleague of mine, and helped build businesses from scratch in the InsurTech space. So how do we leverage InsurTechs to go create, product speed to market, launch new propositions, design things that were customer fit and ready, and do it at pace. So on a personal mission to make insurance lovable, and I get laughed at all the time for that, but I don't think enough people love or appreciate insurance. So that's the mission.
And so, do you feel that because the previous gig sounds pretty sweet, quite frankly, to drive towards that. So if you can tell, what made you switch, apart from it obviously being a really cool sounding company, but I'm sure you looked behind the artifacts.
Yeah, and I should be very clear. I'm an employee of Google. I'm not a spokesperson for Google. But from a personal perspective, I looked at the market and I looked at the folks that I thought could have the biggest impact to go furthest, fastest, and make the largest impact. And I believe some of the things that my new organization has done in terms of partnerships, and you only have to look locally to yourself. If you look at what we've done with Munich Re and AGCS on our risk partnership, and you look at London Market, and you look at Brit and Key, they are all ways in which we're using technology, data, and insights to drive better outcomes for the end customer. So I think any technology you start to bring together, you've got a really great opportunity to accelerate our current pace inside insurance, which I think we will all agree is not fast enough. We've got to find a way to do it.
And so maybe for those of you, because I think you've mentioned two super exciting, almost like light tower projects or initiatives, could you maybe shed a little bit more light for those of our listeners who, have not read the specific use cases as they were spread through the media?
Yeah, no, sure.
Really cool.
Yeah, they are. And actually, the other thing I should say about them is why I thought it was exciting, not because that these two have just come out and they're nothing to do with me. I'm super excited for the folks that led them, is the number of projects like this that took place in other industries with this new technology capability was significant. And as a net result, it just said to me, there's a natural opportunity to do the same or replicate the success we've had in banking or retail or elsewhere in insurance. So the two I mentioned were, one was, it's called Key. It's the first automated follow syndicate in London in association with Brit. So again, leveraging technology, data, insight, scale to go do something that's been around for years, but in a completely automated fashion. And there's loads on the Brit and Key website. And then the second one is a cyber partnership between Allianz Global Corporate and Specialty and Munich Re, where we plug directly into the Google Cloud capability to understand cyber incidents or outages. So it's only applicable today to Google Cloud customers. But if you are in that space, you have an ability to acquire capability to give you better insight and understand your risk in a very, very different way. And that's something that the team have been building for quite some time. And as I say, launched in the last couple of months. So again, just great ways of bringing together insights, data, technology, scale, cloud in a way that solves for one of the more modern insurance coverages, how we go to market, how we can help address some of these things that are new to market.
Cool. I guess, and Tom, please interrupt us. I'm just, whenever I'm talking to Nigel, I just kind of get my nerd hat on, and it's obviously reinventing finance, not just in insurance. But I think and appreciative that this is your personal opinion. Let's have this as a legal disclaimer also. But what is your personal thesis on the insurance industry in terms of where's growth going to come from, which place work, is the industry prepared to partner, compete against, the big techs? I remember, on these conferences. So just very wide, and, you can kind of pick your red thread, which I'm sure you'll do nicely. But, what's your take? What's your thesis?
I mean, I've written about this for years. So, even before I joined the firm, everyone's talked about GAFA, or you head east and you look at Tencent and Alibaba and all the other folks that are out there. I think genuinely there's an opportunity for collaboration, partnership, and everything else to go. Yeah, you just look to the east. How do you buy insurance in the east today? Is it through a super app where actually you live your life and everything's done through someone that's got billions of or millions of access via an app, and everything's centered through that? I've long been a fan, and this is probably one for Tom as well. I've long been a fan of the whole emergence of embedded or invisible finance right now, and I think this is an amazing sector. I worry that we've designed and created products, and I have this whole thing that you've probably seen and got bored of me talking about around, we have all the ingredients, but we just want cake. We don't walk into our local coffee shop or cafe and ask for flowers, egg, milk, blueberries. We walk in there and say, can I have a blueberry muffin or whatever it might be? I think in the finance world, we seem to make customers do all the baking, and we just want to sell them ingredients. So often we'll say, hey, you need motor, home, pet, travel. You also need a mortgage, savings, loans, ISAs, all the things that go with you. Why don't we start designing like we used to for life events? Hey, Nick, you've just got married, or you've just got a baby, or you've just got your first pet, or your kids have gone to school. Your requirements at each and every stage of life go through masses of change and difference. And I think if we realign to your life stage and life event, we've got a better opportunity of having the right products and right services at the right time for those individuals. And I think that's where the collaboration between big tech, small tech, whatever you want to call it, but basically the device that we live in our hands day in, day out, the stage of life that we're at, and then bring back the capability that we'd like to support you. I mean, and a really good example right now, having just gone through a global pandemic and still going through it, of course, is something like telehealth or telemedicine.
Yep.
Jump back 12 months and, maybe you or I or Tom would have gone to a doctor or a GP surgery and sat in the waiting room and waited our turn to see the doctor, ask them our question for 3 minutes and walk back out again.
Yeah.
For the last 12 months, that's all happened via telemedicine or apps or video conferencing on your phone. The question we should be asking ourselves is that ever going back to the way it used to be? And does it need to? How do we use the acceleration of what we just did for the last 12 months to leapfrog forward and do that for every single sector in finance that we can, whether it's mortgages, whether it's regulation, whether it's insurance, whether it's claims adjusting? But actually, we've got a smarter way to engage both our customers and, in this instance, with work from home, our employees.
I really like, let's pull on this thread, let's, embedded finance and insurance a little bit deeper. Out of curiosity, so we're seeing quite a few of these movements happening. I think finance is sometimes more natural than insurance. It depends a little bit on the platform play. In your opinion, is this because, is this more, are you banking more on exclusive, I don't know, let's take Revolut, for example. Revolut partnered with Chubb, they partnered with Cover. If you fast forward, what is your what is your hypothesis around, will it be the super apps aggregating several insurers directly through an API? Is there some aggregation? At which point do you feel that, is that this one policy, or is it maybe, a renaissance of the Lloyd's marketplace, underwriting capacity, but maybe not in a room with a bell? Can you walk us through that, what you see or where you think, based on...
Yeah, there's been so much written about this, and there's some really great articles. Simon Torrance wrote a great article about this. Many people have seen and commented about it. There's some really good initiatives out there. The ones that you've mentioned, I go back to my first point, which is around customer. And I think the question we're going to ask ourselves is, who's going to own the customer of the future? So if I'm in Revolut today and I can do Chubb Studio, I can do cover with Freddie and team for motor, or I go to my bank, I happen to bank with Starling as an example. Through that, you can get Anorak Life Insurance, Pension B, Social with Dylan and team. They are an aggregation of capability to meet the things that you've got. You add in there things like open banking, and you start to go, actually, Nigel's just bought a bike. Why not offer him Lacquer or Casco or others that are out there? So there's loads of opportunity to use the data and insight that we've got from the transactional flow. And being an insurance guy, apologies, Tom, being an insurance guy, I believe the real winner here will be insurance, because it's mandated. I can't drive a car or secure a property, a mortgage on a property, without the insurance to protect the asset. A bank account might be just the storage and transfer of funds and that's it. You can do that in lots of other different ways. Do I think my kids that are young, sub 12, will ever have a bank account in the way that you and I had as we grew up? Probably not. Do I actually think they'll own a car in the same way that we may have done? Probably not either. And I think it's these changes to the way we live and work and behave that are going to drive this embedded finance piece. So on the acquisition of the policy, and when I say acquisition, I mean the rate, quote, bind, provided to you via the app, whether it's a super app, whether it's a banking app or a money transfer app. They're all going to come together, and it's going to be quite easy for you to get. The one thing on my mind that I'm working on quite a lot right now that I don't think is a straightforward answer to is, how does the operating model work going forward? And what I mean by that is, let's say Tom's bought a new house, he's rented a car for the weekend, you've just got a family dog because we're all in lockdown, everyone's got a dog apart from us, and you've got a new bike. That might be 4 or 5 different policies from 4 or 5 different providers, all through your embedded finance provider. But in the unfortunate situation you need to make a claim and it spans multiple people, how does that work from an operating model perspective? And how do you make sure that we make it as easy to engage with on the back end as we do for you to buy it on the front end?
Yep.
The final caveat I'll say on this one is, we've got to be very aware of what European, given our audience, regulation will say. So the Insurance Distribution Directive will tell us what you are able to embed and what you are not able to embed, making sure that customers' needs and wants are fairly met or clearly met, and we don't end up with another over-insured with 7 travel policies or whatever it might be.
Absolutely. And I think, quite frankly, I think it'll flow a little bit with the volume of these transactions. I'd say, it starts out with, on a transactional basis, the things that are contextually relevant. And quite frankly, some things, even within life event, a proper contextual setting is a trusted, and I think trust is really key, a trusted advisor potentially walk you through something. So I think it'll be a kind of like a multi-wave process at some point. But I think the key point is that it won't be lack of technological connectivity that drives this. It'll be cold and hard commercial and competitive forces within the regulatory framework that will kind of dictate which systems work. And also, I would argue, the learned and current shopping, let's say, expectations of a customer. I'll give you an example. So the UK, obviously, motor insurance price comparison site. So I think it's 70% or something, right? Of policies go through.
It's a big number at the moment, for sure.
Right. And so customers have been educated to shop around. You're kind of like an idiot. You get screwed, if you don't. And what that means, I don't know exactly which company it was, but there was in CAS, there was an embedded insurance solution, but they decided to create a panel because they said a UK motor insurance customer is expecting from me as the super app to provide choice. I would argue that is not the case for a Swiss customer, because that level of comparison brokerage on the retail front is not the same. So I think one of the key elements to not forget is take the customer where they are with insurance, and appreciate how they have learned and currently want to interact. And I would try to let someone else do the re-education because that is really costly.
This is a big question. So the UK market, I think, is very mature. Price comparison websites have been around for 20 years. It's not that they are expected to do it, because there's a fair percentage of people that don't use PCWs, and we often refer to it as the loyalty penalty if you don't switch. But the thing the regulator, I believe, is looking out for, and everyone is looking out for, to be fair, is how do we make sure that those who are unable or unwilling to use a price comparison website don't get a bad deal?
Yep.
So we are, as I said at the outset, it's back to how we collectively look out for the customer. Now, I would argue country to country, they're very different, but generation to generation, a 19-year-old in Germany to Switzerland to America to the UK is probably going to be more alike than ever go back 20, 30, 40 years. So actually, I suspect we'll normalize some of these things going forward as we start to get involved with the asset that we want. I'm not going to buy a car. I'm going to use it for an hour. I'm not going to own a house. I'm going to use Airbnb or whatever it might be, or rent it for a period of time. So I think the change in dynamic from a ownership perspective and from a demographic perspective will probably be a bigger driver than history has dictated with things like PCWs. And that brings a whole different conversation about their role in the market going forward, and how what their part is, I guess, inside insurance or finance. Because frankly, they're called price comparison websites. Before them, it was a manual process where at least me personally would sit there with the yellow pages and flip through the book one by one and calling all the providers and asking for what their best deal was. So all I've done is digitize a process that I would used to do manually. The same is true for my health insurance. The same is true for my mortgage. If I want to go compare a mortgage, I go onto a comparison site. If I want to compare my electricity or gas, I'll go onto a comparison site. So there's loads of different ways that I'll use technology to accelerate something that's quite manual. I think the embedded argument is, why is it even a question? Why don't we buy a bike or rent a bike, and for the period that we have it, and scooters is one of my least favorite topics. If you listen to my podcast with Sarah, we talk about e-scooters all the time. In the UK, they are being enabled in some cities, providing they have corporate insurance.
Like fleet insurance by the provider. Is that what you mean?
Exactly that. So the point being, there's no decision point for the customer. It's embedded.
Yep.
Yeah, it's fire insurance also. That's a long tradition.
Yeah, and you know what? If I understand the stories correct, and I certainly wasn't around that back in the day, but fire insurance was one of the ones that came along where you used to have insurers putting plaques on people's building to go, hey, they're insured or they're not insured. But it was no good having a fire brigade going past buildings that weren't insured to fix the building in the middle around buildings to go, well, we fixed the one in the middle, but it's still burned down.
Yeah.
I like your idea of zooming out. The world is flat, different generations. Also, what kind of cycles do you have? And I would refer to this article of Anderson, software is eating everything. then if you move from Deloitte and advising big corporates to Google, are you changing to the company which will eat insurance as an industry?
I think, let me answer the first question first. There's the question I get asked all the time, having joined the business. I think you just need to look at the partnerships that we've created over the last 6, 12, 24 months across all industries to show you where and how we're going to engage the market. And certainly my ambition is very much to enabling and working with side-by-side insurers to accelerate their journey. So I think it's a great opportunity for all to partner and go, actually, what is it we could do that we could never do before at this scale and pace? So lessons to be had. In fact, we're running a webinar tomorrow in the UK on something very similar to this, which includes just some of these topics, but it's very much here's how we work with rather than anything else.
Yeah, but let's say the problem is that there's so much legacy around. So it doesn't matter what you take. I mean, you can also take automotive and Tesla, and they just have the big, let's say, positive advantage of not having the legacy. And they can just decide, okay, let's integrate all the stuff and let's do the distribution ourselves, etc. And here it's exactly the same. So it doesn't have to be Google, but it also could be new players. So even, let's say, a company like Cover, you also mentioned, and was also, let's say, in our last podcast, I'm not quite sure. They just handling.
Not live yet, Tom.
Pardon?
They're not live yet.
They're not live. It doesn't matter because there will be earlier lives than this one. But let's say those new also startups are able, let's say, with 50 people to cover the half of Europe and use, let's say, old incumbents with their, let's say, old structures, which are so based on what is going on in one country. It makes it just extremely difficult to just develop in the same speed like you do. So also, if you have a partnership, how do you manage this legacy?
Yeah, I mean, but what you're describing isn't about big tech or traditional industry. What you're describing is an industry that has 300 years plus of legacy, that has, like many industries, operational debt, technical debt. Many will have been through merger and acquisition, and there is just a problem to solve. And when you bring all those things together, you'll often hear me talk about evolution and revolution. The evolution will be, how do we get 1% better? I'm a cyclist, as Nick was taking the mickey out of earlier, for whether it's Peloton indoors or something else outdoors. But there's a chap called Sir David Brailsford. Sir David Brailsford is team principal, I think, for Team GP and one of the cycling teams. And he has this whole principle of marginal gains. And marginal gains is very much about how you break things down, improve them by 1%, and build them all back up again. And I love that, because that describes finance industries, banks, insurers, or whatever else. We're all too often going, let's install automation or robotics or AI to digitize the old world. The revolution piece for me, though, is, and that's great, by the way, and that can have
outsized returns. I think there's a case study about it in this book, Atomic Habits, and the whole point about it is about the outside. It's it's like compound interest. Right, on incremental.
I'm a massive fan of James Clear. He's helped me, even his weekly email is my must-read Thursday email. It's just brilliant, right? There's always a level of just brilliance. You go, oh, why didn't I think of that? But there's always these micro things that we can do that ultimately get to bigger habits. Now, in the insurance world, where you've got, let's say you're an insurance multinational with thousands of people worldwide, it's very difficult to turn the oil tanker sometimes as opposed to the speedboat. So your options to do that are twofold. You either do it inside the business and work out a different way to do it with the right mindset, people or otherwise. You do it with technology, or you do it outside the organization. And I think over the years, the fintech space, the insurtech space, we've seen companies start up and build, speed to market platforms, because we don't want to take 3 years to launch a product. We want 6 weeks or 12 weeks or something quicker than what we used to do. And Nicholas can talk to this to the nth degree, right? So we've got to have different ways to do it. That's not to say the old way was wrong. And often one of the things I see is they're often additive as opposed to instead of. So many of the companies I worked with in my old organization were doing large-scale legacy transformation, but in parallel, they do short, sharp exercises to create short-term quick wins that would all lead to this bigger goal. So it's not one size fits all, whether it's technology or culture. You've got to work out what's right for your organization. The revolution comment for me, and I'm conscious I'm taking loads of talking here, the revolution comment for me is more about, rather than even thinking about breaking it all down to 1% and digitizing it and bringing it all back together, have we asked ourselves why we're doing it for in the first place at all? And if we were to reimagine it with a blank sheet of paper, what would we do? How many projects have we all been involved with that start with taking a paper or legacy form and making it a digital form? When in reality, we should be able to get in the data at source and paying someone out by a parametric claim if we wanted to later on. So we can short circuit all of it if we start to think about the revolution, not the evolution.
Yeah, but for instance, that's a very good point. But if you, let's say, take insurance is a little bit behind in comparison to, let's say, the banking industry. And if you take, let's say, one example I like a lot is payments. Then payments is just a very old-fashioned part of the banking industry. And if you just see what's going on now, and if you take RTN and Stripe and others, but you can also take PayPal and others, the innovation starts somewhere small in startups, and then in the beginning, all those banks saying RTN, okay, good luck, guys. And then a couple of years later, and it didn't take that long, the valuation of the company is 60 billion. And the Dutch banks, just to take one example, are going down the drain. And segment by segment, and that's why I made the remark to software is eating everything. I think it's a combination. On the one hand, innovation mostly has a bigger chance outside the industry. And it's the revolution part of it. And then in the beginning, it's not seen as a big competition. And then afterwards, it goes much faster. So I'm very curious if you really think that these big incumbents, are they able to overcome their legacy? Because it would be a new phenomenon.
I think there's some really good examples out there of organizations that continue to evolve. A personal favorite of mine I was talking about the other day is Netflix. Netflix started as they bought a company called that did DVD delivery to the house.
Yeah.
And so before DVD, it was, I don't know if it was CD, but DVD, then to Blu-ray, from Blu-ray to streaming, from streaming to content creation. It's a 21-year journey of continuous innovation and not sitting down saying, actually, we've always just done it this way, therefore it's got to stay this way. Because if they did nothing, they'd still be delivering DVDs and Blu-rays in the way that they always had done.
Yeah, but Netflix started with the idea that in the end it would be about streaming, and then it just took longer than they expected it to be.
But equally, if you look at the number of Oscar nominations they've got this year for content created by
That's right.
any studio, they have more than anyone else. So they've almost done the whole thing vertical end to end.
Yeah.
The actual quote I think we should use from this is probably from the same VC house, which is along the lines of, will the incumbent get innovation before the innovator gets disruption? So that's the race, right? And you can't turn around and say any of these legacy insurers or banks or traditional, that's not fair to call them legacy, any of the traditional organizations that have millions of customers that are happy enough will want to move. I often get given out to that I keep designing for us. I keep designing for me. And I'm a nightmare at early adoption. Whereas my mum, who's 77, don't ever let her listen to this, she'll kill me that I've told her her age. But my mum, as an example, is perfectly happy with the services that she's got and doesn't need to change. So it's almost a case of back to the customer and the cycle, who and what are we designing for? Because for the majority, it might be good enough.
So I think that's an interesting point. I think so. It's basically, incumbents get innovation before the innovators get, I think, distribution, right? I think that's, or the customer. And I think it's interesting. And Tom, I think the two of us also have a slightly different view about that, where I think fintech and insurtech do differ by the natural engagement with the product and the frequency, and thus the inertia of the customer. which is why I think a neobank and a direct-to-consumer neo-insurer are different propositions. I get that they can be in the long run, and you can get these things right. And if you get these rights, it's really beautiful. But I guess to kind of phrase that as a question, Nigel, do you think, with that in mind, where would you put your money on at scale? Do you think there's going to be more incumbents getting to innovate with the advancements, the partnership, whatever is at store, and some of the InsurTechs also pivoting into that space, than the disruptors, or maybe new market entrants capturing? And what I mean is significant market share. What troubles me is 5 trillion premiums every year and 20% of that just evaporating in IT and ops. That's the problem. And
my short answer to it is, and I'm going to go back to Tom's point as well. My short answer is, I feel like it's a platform economy. I wrote something a while back called Frictionless Insurance in a Land of Utility. Now, to enable the utility, you need partnerships, of which they have been in place for hundreds of years, between auto manufacturers, between home builders, between building management companies, and each part of the value chain. So for me, it's about the platform economy. The platform economy will go out there and allow you to connect to different pieces and serve, engage, whatever else that you do. But what we're slightly taking into account here is the cycle of engagement. My bank account, I'm not a banking individual at all, but my bank account, I check on a regular basis. It's daily, it's weekly, or whatever else it might be. What bills are going in, what bills are going out. It's transactional. Have I got enough money there to cover it? Do I need to move money around, etc.? Or can I spend this? Can I afford this? Insurance is a stage behind that, because it's annually, every 6 months, quarterly. It's now moving in some instances to monthly, but my engagement level is very low. But then I go to mortgages, Tom, and probably much more your space than mine. But I engage every 5 years or every 3 years. I complain about the process every time because it feels archaic compared to what we've done in insurance. It's got better over the years, without doubt. But by the time you've got land title and all the other pieces that you need and whatever else in shape, it feels antiquated. But then I don't touch it again for 5 years or 7 years or 10 years. So it does depend on the type and level of engagement that we have to do. And if we're pushing for more engagement, the one that engages most is a Revolut, or is your bank account, or one of those people that we are looking at on a regular basis. We are starting to see some insurers now doing lots more engagement, whether it's through IoT or connected home or telematics or connected health with your watch, or whatever it might be. So all these things are coming together, but they're coming together through APIs and platforms. And we've seen behavioral insurance, we've seen behavioral banking, we've now seen behavioral driving. So all these things are using signals or sources from the third party, car, watch, health, exercise band, Fitbit, you name it, to bring it back and go, how do we use this insight to make you a better individual going forward?
Well, let's say if you take, for instance, the banking industry, I think it makes it easier, let's say, for scale-ups to scale globally, because they only have to concentrate on one segment. So if we go back to the payments, if you take Stripe and Adyen, they take one segment out of the whole banking industry. They don't have the legacy on the one hand, and they can 100% concentrate on scaling these payment services on a global scale. And that's what the Stripes and Adyen's do. And my question would be, if, let's say, it could be Lemonade, but it could also be others. I think it's easier to give a scale up which already has a product market fit, scale globally, because they don't have the legacy and they only have to concentrate on one segment. And the problem is that you have to, as an old insurer, in a lot of cases, if you talk about Allianz and AXA, if you talk really the big ones, the problem is that you really have to take care of all those different segments.
Yeah, it's a really interesting point. And you're picking on payments. I'm certainly not a payments expert. We've got plenty of people that are in the organization, given what we do. But it does feel like insurance might be localized in country and regulation, but payments is probably more universal globally. I'm making an assumption. As I said, I'm not probably qualified to do it, but it feels like it's more universal country to country. You've got companies like you've mentioned, like checkout.com, like Fast. There's some really good innovators out there that are doing things in a very different way. I mean, it goes back to my evolution and revolution comment. Taking a physical plastic card and putting it into a digital mobile device is an evolutionary step, not revolutionary. Because all we've done is take the physical thing we had, and now we're using it on our watch or our fitness device or our phone or whatever it might be. That process hasn't really changed, has it? All we've done is take out the physicality of the old world. So it's an evolutionary step. The revolution might be, how do you do the transfer immediately once the transaction takes place? And it's not an area I've thought too much about, but I've always thought I love the idea of my payment mechanism being on my phone, but it is just an evolution. We all get excited by it, but it is evolutionary.
That's right.
So I guess if let me try to formulate a kind of a sharp hypothesis, and then you please plug holes into it. So if we believe into an aggregation of the platform economy, check, right? I think that's where a lot of growth. If we believe in the potential of embedding finance, invisible finance, leveraging, better underwriting, check. But if we also see that insurance, different to maybe some other financial products like payments or loans, it's not just the individual or the size of the transaction, it's very much the asset. The underwriting of the asset is different, and the fulfillment of the service is also slightly different, especially if you were to go with certain service operations, because it's not just about payout, right? You cannot just do. So if that is true, platform embedded, but variance of services to a larger degree of variance than you would have in payments or other embedded finances, wouldn't it then lend itself towards a aggregation of best in class, maybe even national services? Because the scale effects of regulating a motor claim in Germany versus the UK and France is effectively nil. There's very few scale effects, and that with these things, what we would see is another layer of aggregation that connects these in a uniform technical level, but the service. So I see not, one insurance corp of the world insuring everything. What I see is a digital Lloyd's of London with specific underwriting houses, servicing houses that get access through APIs and that continuously bid on the servicing of these super apps. Where am I going wrong?
You're not at all. The thing I would say to your last point about Lloyd's or otherwise, and the whole concept of underwriting is not everyone takes, if you go to the commercial world, obviously 100% of the risk. We work out how we share the risk based on people's appetite. Back to the lead and follow example. The lead insurer might take a percentage, and then you've got a number of follow-on people. And we do that to make sure that we don't aggregate risk in a certain space. So we've got to work out how we share and spread that accordingly amongst multiple people. And that might be because, hey, you're insuring natural wind power in Germany or offshore energy or whatever it might be, and you are experts in that area. So you'll take the lead because you can apply insights, risk insights, knowledge, capability that no one else has got. And others are just providing capacity behind that. So I think it's different from a commodity product to it is to a complex risk product. So we can't bundle them all together. And then you get into, I guess it's a short way to say it is, it's different by line of business. Mm-hmm. And it differs whether it's commodity and scale or non-commodity and not scale.
And I think that is the very interesting point about this, that, it is different per line of business, but within an ecosystem within a platform, you have at the very least, the customers and potentially the suppliers, maybe even the employees, and the whole risk landscape within, a car is actually quite varied, because underwriting a loan and a car and travel, kind of merging this together. So I think that aggregation will happen on a line by line basis, and it will then be dictated whether it's a commodity, whether that commodity by some, insurance as a service providers, they're actually just fronting and passing the risk back along. So they're really just, throughputting. And that's what I mean. That's the beautiful thing about where insurance kind of stacks in third, fourth, fifth place as these ecosystems aggregate.
But it's almost like you walk into a hospital and you can go to the X-ray department to have your leg repaired in a plaster cast, have your eyes checked, or go for an ECG in the heart machine. But you've always got to go to the specialist. You don't go to the dentist to get a checkup on your foot. And if you do, I'll be really worried, right? So it's about specialism, but the overall remit of healthcare has so many different facets to it. You've got to go through the thing that matters at that point in time. So as I started going, as our family grew, you started out with the midwife team, and then you go into the pediatricians and everything else that you do going forward. So it's just making sure we have the right people at the right time, back to customers' needs at a moment in time. And that always changes, doesn't it?
Absolutely. Conscious of time, I mean, I have a ton more questions, but Tom,
I can talk for hours. The world knows this already, so I'm going to pause for a second.
Tom, do you have another comment, question before we wrap this up?
No, it was very interesting. It's I'm just very curious how this will evolve. So the more you zoom out, the more, and you take other industries. I just see the car, let's say, in your and on your wall. You have so many examples of, let's say, people or companies who specialized on products, and then afterwards they were global market leader for sports cars, etc., etc. And if you go back into the industry, mostly was a national way of dealing with it. People who were building cars, etc. You would just go there before there were cars and say, okay, I want to have a bigger car, and then they would produce locally your stuff. But it's the same with fashion, etc. So you went to the tailor, and now you have a few companies who produce on a global scale our stuff, and we go to Zara or H&M, etc., etc. But this whole idea, so I often think we have to zoom out to see the bigger picture, and then examples like the tailor and mass consumption of fashion is a much better example than losing yourself in this kind of details.
And honestly, the car example, there's so many good synergies or examples that can be played between insurance and finance and motor. Motor vehicles or motor racing is an example. You have regulations in each country of things that you can and can't do. The height of the indicator on the front or the back, the brightness of the lights, all defined either at a European or country level. The principle of getting from A to B is the same.
Yeah.
But the rules of how we engage and who we engage for differ widely by customer type and by country type. But the only way every one of those gets better is when the car manufacturer works with the engineering providers, that works with the tire manufacturer, that works with the glass manufacturer, that works with the regulator. So going full circle back to our very first point is understanding the customer, and collaboration through partnerships end up with the right product on the right time for that customer in their life cycle.
Awesome. Last, very easy question. With all of this change happening, what do you think stays the same? What won't change in insurance? What are the roots that we shouldn't lose sight of with all the super apps and the platforms emerging left, right, and center?
What won't change? It's a really solid question. The underlying principles of insurance don't change, period. And it will always be mandated for us to do things. And I have always said it's the stuff that ensures the world moves smoothly. So my only ambition, as I said, is to make it lovable, which means we need to understand it, which means we need to know what we're buying and why we're buying it. So The fundamental premise of insurance and risk pooling and all the things that go with it, I don't believe will change in the short term.
Awesome. Nigel, thank you so much. Was a real pleasure, not a surprise. And, greetings across the channel, and hope to see you soon face to face, if this whole thing blows over.
I can't wait. I can't wait for life to head back to some level of normality very soon. So, but really appreciate it. Thanks, Nicholas, and thanks, Tom, as well. Really appreciate it.
I just
Thank
got
you
my
so much.
second vaccination today, so I'm able to join live again.
Good for you. I think I'm still far off the list.
Thank you very much.
Thank
And
you so much.
a
Take
lot of
care.
success at Google.